Differences between a down payment and closing costs. That's the topic for today's episode. And without further ado, let's dive in. Hello everyone and welcome back to another episode. For those who are tuning in for the first time, this is your channel for real estate education. So today it's going to be about learning the differences between a down payment and closing costs. Now, I know that some of you are probably familiar with what that is, but I have a lot of subscribers, a lot of beginners, and it's some of the questions that I've actually heard about over and over again. So I want to make sure I address that in today's episode. So let's go into the board and learn about their differences. So the first thing I wanted to highlight is that the down payment contributes towards the equity of your property. So whatever you use as a down payment, it's part of the pricing that you're going to pay for the property itself. Meanwhile, the closing costs are just simply fees that you have to pay for someone else's service. Call it the title search, call it the real estate attorney that's helping you with the closing, depending on the state that you are, some of the inspections that you have to pay for, etc., etc. So these are actually fees and they don't go towards the equity. That's an X right here. They don't go towards the equity of your property. The second thing that I want to highlight in terms of down payment is that it's highly dependent on the type of mortgage that you have. So there are various mortgages in the market. There are the FHA loans, which require somewhat between 2 to 3%. And if you don't know what the differences are, don't worry. I'm actually going to include the link down below to another video so you can learn a little bit more about that. And while I'm writing here, do not forget to hit the like button because it's going to help the channel rank and give access to this awesome information to other people like you who are actually looking to learn more about real estate. So back into the board right here. So you can have the FHA loans, you can have like the regular mortgages that most of you have heard about, which requires the 20%, or you can also request for commercial loans, which will typically require 25% of down payment. So it's highly dependent on the type of mortgage. Meanwhile, here over the closing cost, it doesn't matter what type of mortgage you have because these are set fees that you're gonna have to pay anyway. So set fees, they are not impacted by the type of mortgage that you have. So I'm gonna X the mortgage right here, right? And then the next thing I want you to take into consideration between the differences and the similarities, and one of them is that number 3, you have to show fund seasonality, right? You have to show that you actually have the funds in your bank account, because based on that, they're gonna want to ask you to wire that money to the closing agency, to the buyer, whether it's 2 to 3% or 5 sometimes, or 20 or 25%, right? Meanwhile, with closing costs, you don't necessarily have to use those funds in your bank account. You can actually pay for those fees using a credit card, or you can use the money in your bank account and just simply wire them. But you don't need to evidence where exactly or how exactly you're paying. Meanwhile, here they want to see, because it's a large amount too, where exactly is that money coming from that's going to help you contribute this 20-25% all the way up to the equity of your property. Another thing I wanted to highlight is that the down payment could get impacted by your credit score. So we're gonna see here 5, and I'm just gonna write FICO for your FICO score. Why exactly? Because depending on your FICO score, depending on the loan that you ask, they might require a higher percentage. Maybe you did qualify for an FHA, but maybe the bank decided not to give you the 2%. Maybe they decided to ask you for a 5%. Or same thing with the regular mortgage. Maybe the minimum is usually 20%. But depending on your risk factor, depending on how risky you are, and if you have no idea what I'm talking about, there's going to be a link here down below so you can actually learn about it. You could be asked to provide more than the 20%. So it's sort of like indirectly correlated. It could impact it. So it's something that you definitely need to take into consideration. Here, I mean, it has nothing to do with the credit. I mean, they could care less. Fees are fees, so therefore you have to pay them. And that's in terms of differences. They do, however, have some things in common. So for example, down payment and closing costs are usually issued at closing, right? You give them a lump sum, you give them the overall amount that you need to contribute towards down payment, and then whatever fees that you pay separately that you don't have to pay up front, you wind up paying those closing cost fees at the end and at the closing. And if you are a little bit more creative, like some of you who are already subscribed to the channel, you might leverage credit cards for the issuance of that down payment, as long as you have that money seasoned in your bank account. And if you have no idea what I'm talking about, there's also a link down here below so you can learn a little bit more about that. So hopefully this video has helped everyone to come up to speed in the channel. So for those who are tuning in for the first time, welcome. And for those who are already subscribed, thank you for your support. Again, do not forget to hit the like button and let me know what your thoughts are. I would love to hear about everything you have to say and your thoughts and the content and what else you would like to learn about in this channel. And that's pretty much it. That's all I have for today. And I will see you guys around. I'll see you soon. And until then, bye bye.